Have you ever thought about investing but didn't know where to start? Maybe you've heard people talk about building wealth through investments, but it seems too complicated, right? What if I told you that you can start with just $1,000 and build a solid investment portfolio from scratch? No need for expert-level knowledge or a ton of cash. It's totally possible, and I'm here to show you how. Today, I'm going to walk you through 10 steps that will help you turn your $1,000 into a diversified investment portfolio. Whether you're a complete beginner or just looking to improve your investment game, this guide is for you. So grab a pen, take some notes, and let's get into it. And before move, make sure to hit the subscribe button so you don't miss out on more practical financial tips. 10. Set clear financial goals. Before you start investing, you need to know why you're investing. Are you saving for retirement, building wealth for the long term, or just looking to make your money grow over time? Setting clear goals helps you determine your investment strategy and decide where to put your money. Ask yourself, how long can I leave my money invested? Long-term versus short-term. How much risk am I comfortable with? What return do I hope to achieve? Knowing the answers to these questions will guide your decisions as you build your portfolio. It's important to have a plan so you can stick to your strategy and not get swayed by the ups and downs of the market. 9. Understand risk and reward. When you invest, you're taking on some level of risk. The goal is to understand the trade-off between risk and reward. Higher risk usually comes with the potential for higher returns, but it can also lead to bigger losses. For your first portfolio, it's a good idea to start with investments that match your risk tolerance. If you're more conservative, you might prefer safer options like bonds or index funds. If you're willing to take on more risk, stocks could be a better choice. Don't worry if you're not sure what your risk tolerance is. You can start with safer, lower risk investments and gradually adjust your portfolio as you get more comfortable with the process. 8. Build an emergency fund. First, before diving into the world of investments, one of the most important steps is to establish an emergency fund. This fund acts as a financial safety net, ensuring you won't have to dip into your investments during a crisis. It's generally recommended to save between 3 to 6 months' worth of living expenses. This gives you enough cash to cover unexpected events like medical emergencies, car repairs, or job loss, without needing to sell investments at the wrong time. Building your emergency fund might take some time, but it's worth the effort. You can start small. Just set aside a portion of your income each month. Consider keeping the fund in a liquid account, like a high-yield savings account or money market account. This ensures easy access to your money when you need it, while earning a little interest along the way. Without an emergency fund, you risk having to sell your investments at an inopportune time, possibly incurring losses. So before you think about investing, prioritize building this fund. It's the foundation of any solid financial plan. 7. Choose your investment vehicle. Selecting the right investment vehicle is crucial for building a successful portfolio. There are several types to choose from, and each comes with its own set of pros and cons. Let's break them down. Stocks. Investing in stocks means buying a share of a company. It's one of the most popular choices because stocks offer the potential for high returns. However, they can be volatile and come with a higher level of risk. Prices can fluctuate significantly, especially in the short term. But over time, stocks have historically provided higher returns compared to other investment options. Bonds. Bonds are essentially loans you give to companies or governments. In return, you earn interest, and at the end of the term, the principal is repaid. Bonds are generally safer than stocks but offer lower returns. They're a good way to balance risk in your portfolio. Mutual funds and ETFs. These are investment funds that pool money from many investors to invest in a range of stocks, bonds, or other assets. They provide instant diversification, which helps reduce risk. ETFs are similar to mutual funds, but they trade on the stock market like individual stocks, offering more flexibility. Each of these investment vehicles has its place in a well-rounded portfolio. It's often best to diversify by including a mix of stocks, bonds, and funds to balance risk and potential reward. 6. Start with index funds or ETFs. If you're just starting out and don't have much experience with investing, index funds or ETFs, exchange-traded funds, are a great choice. These funds track a market index like the S&P 500, which includes the 500 biggest companies in the US. Why are these great for beginners? Because they automatically give you diversification. Instead of buying individual stocks, you're buying a little piece of a lot of companies. This reduces your risk. For example, if you have $1,000 to invest, you could buy an S&P 500 ETF for around $300 per share and get exposure to 500 companies instead of just one. Plus, they're relatively low cost compared to actively managed funds. 5. Diversify your portfolio. One of the most important principles of investing is diversification. This simply means spreading your investments across different types of assets to reduce risk. You don't want to put all your $1,000 into just one stock or one type of asset. Instead, you could split your money between stocks, bonds, and maybe even some cash to give your portfolio balance. For example, $400 in stocks, like an S&P 500 ETF, $300 in bonds to reduce risk, $200 in cash to keep it liquid. Diversification helps protect you from market downturns. If one part of the market is struggling, the other investments can help cushion the blow. Dollar cost averaging, DCA. Dollar cost averaging is a strategy where you invest a fixed amount of money at regular intervals, regardless of the market's performance. This reduces the risk of investing all your money at the wrong time. For instance, let's say you decide to invest $100 each month into an ETF or mutual fund. If the market is down, you're buying at a lower price. If the market is up, you're still investing consistently. DCA helps take the emotion out of investing as it prevents you from trying to time the market, which is extremely difficult to do. 3. Reinvest your dividends. Many stocks and ETFs pay dividends, which are like small payouts to shareholders. Instead of cashing out these dividends, you should reinvest them into your portfolio. By reinvesting, you're buying more shares of the same stock or ETF, which helps compound your returns over time. This might seem like a small thing, but over the years, it can make a big difference in your portfolio's growth. 2. Monitor and adjust your portfolio. Regularly investing isn't a set it and forget it thing. You need to check in on your portfolio regularly to make sure it still aligns with your goals. At least once a year, take a look at how your investments are doing. Are you still on track to meet your financial goals? Has your risk tolerance changed? If you need to, rebalance your portfolio. For example, if stocks have grown significantly, you might need to move some of that money into bonds to maintain your desired asset allocation. 1. Be patient and stay consistent. Finally, the most important thing to remember is that building a portfolio takes time. Don't expect to get rich overnight. The power of investing is in the long-term growth, and the best thing you can do is stay patient and consistent. Continue to invest regularly, even if it's a small amount. Over time, your portfolio will grow, and you'll start to see the benefits of your discipline. The key is to stay in the game and not panic during market downturns. So there you have it, a simple guide to building a $1,000 investment portfolio from scratch. I know it might seem overwhelming at first, but with a little time and effort, you'll be well on your way to building a diversified and solid portfolio. Remember, the earlier you start, the more time your money has to grow. So get started today, even if it's just with a small amount. Every little bit counts. If you found this video helpful, don't forget to like, share, and of course, subscribe for more tips on how to manage your money and build wealth. Thanks for watching, and I'll see you in the next one.